Welcome to the Mississippi State University College of Business Family Business Education Initiative responding to COVID-19. Today's session, COVID-19 tax relief with Katherine Little, a CPA, and this one's a tough one. This one gets complicated. We've talked about marketing and some other things, but the tax implications of COVID-19 can be pretty complicated, particularly for folks who don't do taxes for a living, right?
Absolutely, absolutely.
So how are we going to tackle this? What are the things we're going to go over today?
Well, really the biggest things that we saw coming from, from the COVID relief, first we got, extended deadlines. We saw a lot in the payroll tax department. So really with payroll tax credits, I'd really like to hit on that a little bit because those are they're confusing and they're also very beneficial if you utilize it the right way. And then also there are a few tax things that we could be taking advantage of as far as net operating loss and a few things that happened in the new tax law changes that the CARES Act actually retroactively changed back. So it was to the benefit of the taxpayers.
Well, let's jump right in with the extended deadlines. What's that look like for businesses?
Wow. Well, July 15th has never been so busy as it was this year. July 15th ended up being a little bit more of another tax season for us. But when all of this hit, it was height of tax season. So middle of March, we found that we actually had gone through a few of our business deadlines at that point. We had gotten our partnerships and our S corporations extended their March 15th deadlines, but everything that was due on April 15th got extended to July 15th. But also, we actually grabbed in our nonprofit deadline, so that's usually May 15th, and that got pushed. But along with that deadline was actually the benefit of being able to defer paying your taxes. Mm-hmm. So if anybody had taxes due at April 15th, even though they filed, they had an option to wait until July 15th. Tax didn't go away, but it did give people a little bit of time to say, okay, we don't know what COVID's going to be like. Do we need to hold on to this cash right now or pay it to the government?
Well, so you got a little breathing room, and then came the Families First Coronavirus Response Act, and that's just a lot of stuff, so I'm going to let you unpack that any way you want.
Wow. Well, really and truly, when we got started looking at all the COVID, this was the first one that came out. Didn't seem like it was a big benefit at first, and actually we feel like this is probably the most powerful of all the credits that you could be taking on your payroll taxes. And the reason I say that is because really this Family First Act, what it really did was it kind of went hand in hand with the Family Medical Leave Act. And a lot of people are familiar with that if they've been on maternity leave. It's where an employer can't let you go for, specific, they can only let you go for specific reasons. And I know someone else has already covered all the details on that. But with coronavirus, it was something very different. We didn't know really what the workforce looked like. And this was a way to protect employees. And so essentially for employers who have less than 500 employees, they fall underneath this umbrella for the family medical leave under the coronavirus. Also, if you have less than 50 employees, there's a few specifics on this, but a lot of people who qualify as a small business exemption, if they just have a few exceptions where they can't fire an employee because they're the key employee, it might detriment their, it could be the end of their business if they try to pay leave to an employee. Mm-hmm. So there are a few things you have to make sure that that's all documented, but pretty much that gets us through some of the exemptions there. But really and truly, if you want to take advantage of this as businesses, the biggest thing about it is that you have a few components. And I know right now we are in the middle of it where if we test positive, we're home for 2 weeks. If our child tests positive, we're home for 2 weeks caring for a child. If we have an elderly parent, we're at home caring for them. So really this opens it up to say, okay, you'll be paid your pay, but we'll also, the government's coming in and saying, but we'll also give you a credit for this on your payroll taxes.
All right, and we've got refundable payroll tax credits.
Mm-hmm. So the way I like to put it, and this is just the best way I can understand it, is that essentially the government's going to pay you to keep that employee hired. Now there's some caps, so they're not going to say your top earner is going to continue to make $10,000 a day, mm-hmm. But they do have some limits in there. But essentially they're paying you 100% if you're at home with the coronavirus, and that's on the qualified paid sick leave, that person can get paid 100% of their pay up to $5,110, I believe that's the number, over that 2-week period. So essentially, let's say I'm a company and I have an employee, and as long as they are out and we can say they were out, they tested positive or they were sick with symptoms, we have to list a lot of those things and keep them on hand. But essentially, I can turn around when I file my payroll tax return and get a credit for that amount. And so it's their gross pay. So I mean, it's really covering a lot of expenses there, including payroll taxes.
And family leave is part of this as well?
Mm-hmm. Yes. So you have your sick leave, and that's if the employee is sick.
Mm-hmm.
The employee, let's say they're sick at home with symptoms, or they're actually they have to stay home. That's another stipulation there. In that case, they get paid 100% for 2 weeks. Then let's say 2 weeks later that the child comes down with it, which is very much what's happening in our environment right now. The family's getting sick. Then that goes on to where they could get 2/3 of their original pay, up to $2,000 for a 2-week period. And then it expands it out to where you could have, say, a 12-week period. So you combine this extra 10 weeks that's out there for the family qualified leave, along with the other leave. So it really is, you can get up to $10,000 with that. Plus you can put it with the other credit as well. So maybe up to $15,000 credit there on your payroll taxes.
All right. So what about the accelerated payment for the cost of providing that?
That's a great question. We've actually gotten that a lot because a lot of our clients, we're looking at their cash flow. That's the really important thing. And so when you talk about leave, that means that they're paying employees ahead of time. And so you've got to have the right fit there and the right dynamics, because with the accelerated payment, the government kind of recognized that, like, hey, we're putting employers out by them paying and then waiting a whole quarter to file and get this credit. So you can file in advance to get it. You file a Form 7200, and that will they will go ahead and foot the bill for you. And all of this reconciles out on your Form 941, and that's how you file your payroll taxes.
Well, give us a couple of examples.
Okay. Yes. So let's say that the employer paid $5,000 in sick leave, and then let's say they have payroll taxes outstanding of $7,000. So when they file their 941, they're only going to pay $2,000 in payroll tax. But on the flip side, you might actually pay more in sick leave than you have in a payroll tax liability. So let's flip it and say if the employer had $10,000 in sick leave, but they were only required to pay $7,000 in payroll tax, then they will actually request the remaining $3,000 in a refund in their pocket.
All right. So then the next thing would be there's an employee retention credit.
Mm-hmm. Yes.
How does that work?
Well, I will like to say PPP has kind of ruled our world, and that's the payroll protection program. Essentially, the employee retention credit is another form of PPP. I say that it's kind of like using a coupon where you're going to get this credit over here, you're going to get this PPP, and you got to kind of pick which one is more advantageous to you. PPP, a lot of people who applied for that, they probably have already extended their 8-week, or they're getting close their 24-week period where they can, their forgiveness period. The employee retention credit is only if you didn't take that. So we're seeing very few of these actually. A lot of the times it was, when we looked at them side by side, PPP was more advantageous. Mm-hmm. So I'm starting this out saying this isn't maybe as much of an impact, but now this is great when we have clients come in and say, we didn't file for PPP. And so if they didn't, this is a great opportunity for them to recap that on some of their employees.
So why would they have not filed?
There are a few reasons. Some people just said, I just didn't need it. Or they didn't understand. Not that it was an easy process. It was still going through a long process. Most people just really, the ones I talked to, and finally when we had a conversation about, I say like 3 lines in, be like, well, this, and this. And they go, oh, well, I'm going to go file for my PPP, But a lot of people just missed the boat, where they just either didn't have employees, didn't think they qualified as a self-employed person. And in this case, we could recap it. But PPP is still, at this point, they've expanded the application process. So a lot of people even if they're looking at this, we can still say, hey, why don't you go ahead and apply for PPP? And so there's still some planning opportunity there.
And even with the employee retention credit, there are some exceptions. I mean, it's not everybody, you can't just run out
Yeah,
and get it.
this is not an everybody, this isn't one size fits all. So the biggest thing is if you did receive PPP or the economic disaster loan, or if you were a state or local government, you could not apply for this credit on your payroll tax.
All right, and how do you calculate
Okay.
that?
So that's 50% of the qualifying wages. One stipulation, and I'll have to review my notes on this one because it gets hairy quickly on this one. You actually had to be shut down. You had to have, your business had to be fully or partially suspended by government orders due to COVID-19. And so with that alone, a lot of people, you know, an essential business that stayed open wouldn't qualify for this. So, and then also with the, you know, with the state and local, they couldn't apply for it. If you got PPP, you couldn't. And you also had to look at your gross receipts. So you're actually looking at your bookkeeping very closely within each quarter to make sure that you had gross receipts were below 50% of the same quarter in the prior year. So a lot of hoops to jump through. What we find is, of course, PPP was much better, much easier to get through the hoops than this, but this is still out there.
And there was an employee threshold with this as well.
Yes,
right?
absolutely. So then it depended on, well, what if the employee worked or didn't work? So if you had more than 100 employees, the employee that you're paying to qualify, they actually had to receive less, they actually had to be gone. They had to be absent from work to be able to qualify for it. But if you had less than 100, so if you're a little bit smaller employer, even though the employees worked, you could still, you know, qualify for this retention credit. But we're seeing very few of this, I'll be honest. This is one that is worthy of mentioning. It's definitely a great one out there. You can also do an advance payment like we were talking about with the Family's First credit. So you can go ahead and get that in advance. But this one is just a little bit less seen. Oh, and this is a really great point too. I'm sorry, I'm thinking of all these great things and how they all tie together.
That's why you're here. This is good.
But with the employee retention, and a few of these credits I'm going to mention, they can't be used together, or some can be used together. But with the employee retention credit, you can use this with your Family First credit.
Okay.
But the only issue is that you don't want to use them for the same wages. Meaning, if you had someone on leave and you paid them for being out with Corona, you really don't want to turn around and you can't turn around and use the same wages. So you want to make sure you're really documenting where your wages are coming from in time periods that you're using it for.
You've covered so much on just this piece of the puzzle. So folks, if it is confusing, we're going to just leave this. We're not done, but we're about finished with the employee retention credit. But we want to leave this up here because it's just so much information.
And this link right here will actually go to really an easy to use how to navigate through a lot that we just talked about.
So let's shift gears a little bit and talk about the payroll tax deferral.
Yes, the payroll tax deferral was put out there to help businesses with cash flow. That was the biggest thing, and really with payroll tax, it can get pretty hefty by the time your 941 comes around. A lot of people have to make deposits on a more regular basis, depending on the liability portion of their payroll. So depending on that, it could be a cash drain. And so, in an effort to kind of push this out to the businesses, the payroll tax deferral was put into the CARES Act, and that was fantastic. So starting after payroll tax due after March 27th of 2020, ending at the end of this year, at the end of 2020, you can defer that. And so PPP almost dampened this one. Luckily, we had a new PPP Flexibility Act that came through in June that actually removed some of the restrictions. At first, you couldn't take the payroll tax deferral if you had PPP. And it was really to the disadvantage because the payroll deferral really didn't have much to do with PPP. So we couldn't understand how those were intertwined. The payroll tax deferral, what it's essentially going to do is say, okay, well, we've got all this payroll tax due. At the end of the year, you can defer. I mean, actually, you can defer it just by not making your deposits, but you still have to file your 941. So a lot of people don't realize that. You still have to make sure you're filing that. The biggest thing with payroll tax deferral is it's not all your payroll tax. Sometimes when people think about their 941, they're thinking, okay, we've got Social Security tax, we've got Medicare tax, we've got the employee share of Social Security and Medicare tax, we've got withholding that we've taken on the employee. The only portion of that that can actually be deferred is that 6.2% Social Security portion. You cannot defer the other taxes. So there's just a portion of it. Your tax is still going to be due. So really, we found this most beneficial for those clients that really, really just the ones that just had a cash crunch, just needed to get something deferred. This was a good way to push that down the road. But we always made sure there was a plan in place because that can kind of mushroom on you come the due dates. Those due dates, half of it's due by December 31st of 2021. The other half all becomes due then at December 31st of 2022.
And so who's eligible? What businesses are eligible for this particular program?
So really all businesses. I mean, honestly, I would say the people who were going to be restricted first were going to be the PPP, but now we've wiped that out with the Flexibility Act that came out. Then also I would like to touch a little bit on self-employeds. They really benefited from it as well. And a lot of people go, well, how's that so? Because when you think self-employed, you think, okay, well, I've got a Schedule C on my 1040. How do I benefit from that? Because I file in the spring, that's forever away. But essentially those self-employed people should be paying in quarterly estimates. And so those quarterly estimates, you would have an underpayment penalty if you didn't follow your quarterly estimate schedule. So how this affects them is that they can actually take half of their self-employment tax out of their estimate, and so their underpayment penalty will be reduced. And so I think we're probably going to see a lot more of that come, say, next tax season when we're seeing the Schedule C's, pushing through.
And of course, as you mentioned, it's got to be done on time.
Yes, absolutely. And so, and actually with the timely deposits, a lot of people it depends on when their payroll is. So if they have different pay dates, you're still required to make those. They were required to make those deposits, but let's say you plan on deferring, you can actually just not make your deposit, and there's not a penalty associated with that.
So there's no application to...
You don't have to let them know.
You just don't do it.
You just don't make your deposit. But now, the one thing that I would like to say is you've got to file the 941. You don't have to pay the tax on that, but you do have to file that.
And you talked a bit about self-employed.
Yes.
All right, so now the next topic, the net operating loss carryback. You need to take a breath. You okay?
I'm good. I'm
right.
good. I could talk all day on these.
Okay.
Yes, so the net operating loss, what I found most beneficial is that a lot of people who carried net operating losses prior to the CARES Act, we had a new tax law come through, and that was where all the individuals really they saw where their personal exemptions went away, but then their standard deduction was doubled. Which one? So that was back in 2018. But along with all the tax cuts, they have to figure out a way to the revenue generating side of it. And so there were a couple of pieces on the revenue generating side of that tax law. One side was NOL. They limited what you could do with your NOL. And your NOL is a net operating loss. So, let's say you just have a really tough year and or you just have a year where you just have way more expenses. And that, what you used to be able to do before 2018 is you could carry it back 2 years or elect to carry it forward 5. And so, I'm sorry, you could carry it forward 20 years, my bad. So after 2018, they said, okay, we're not going to allow this because, if you've got this NOL, you could essentially be using it for a very long time. You could carry it back, it could mess up prior year tax returns, and then, go forward. So what they did was they said, okay, no more carrybacks. Can't carry it back anymore, and you can only use 80% of it. in any given year. So it couldn't wipe out your complete tax liability in any given year with the new tax law. Well, then the CARES Act came in, and it pretty much, I would say that it took that revenue producing factor out of the new tax law, and it just wiped it clean and said, okay, look, so now you can carry it back 5 years. I believe that's the case. You can carry it back for 5 years, and then you can carry it forward indefinitely. And you can go all the way back to 2018, 2019, or 2020. So in 2018, let's say you had an NOL, you could carry that all the way back to 2013. So if you had some tax liability out there, this is a way that you could amend your tax returns, carry those NOLs back, and get a refund. A lot of people just know in the future, hey, I'm retiring. They know they just know they have decisions going forward that an NOL may not be advantageous. Definitely worth going back and amending and getting that refund back for those prior years. But that opened up a whole can of worms. To go all the way back to 2013 is pretty intense.
Well, a lot of this is pretty intense, and I think it's probably fairly daunting for somebody who just has a shoe store, wants to sell shoes, and they've got to now figure all this out. I guess you need to this is a great time to have a good working relationship with your CPA, right? Yes,
absolutely. What we have found through all the credits is that tracking. If you don't have it coded correctly, there's no way that you're going to find out if someone used the sick pay 100% credit, or if they use the 2/3 family medical leave credit. Payroll is really crucial right now because a lot of people do try to do payroll on their own. And before now it has been fairly simple. But when you start looking at these rules and these credits, essentially the government's going to pay for your employees to take leave. And that's huge, and under the right tracking, you could definitely take advantage of your company can continue on, as well as your employees can continue to take care of, they're not faced with a lot of the uncertainty, because I know COVID's put a crunch on everybody. They're wondering how they're going to stay employed and how they're going to continue to be paid, and this really helps with that.
Well, and a new package is on the way, so there might even be some new twists and turns you're going to have to
absolutely
to learn.
With the new stimulus package that they're talking about, we might see some changes in the existing CARES Act. So we might be seeing a little bit. Hopefully, they won't undo a lot of the good they've done. I don't think so. It's definitely the intent is to expand upon some of this. So we're really excited about it, but just like all the other tax laws, they're constantly changing. So definitely with the new stimulus, we'll see where that takes us.
Well, we want to thank you for your time and your expertise on this. Again, this is Katherine Little, a CPA with Lott Company, and there is her contact information. It's a lot to go through, and businesses don't need to try to do this on their own. This is some complicated stuff.
Absolutely. It's complicated for us, and it's definitely something that we dive in and we look at every day and still have questions.
Well, thank you so much for sharing your knowledge with us, and we certainly hope that you found it helpful to your business.